All right. So, hey, everyone, welcome back to the deep dive.
Yeah.
We're all busy.
And
right?
nice,
And, we want to quickly get to the important stuff, learn what we need to learn so we can get back to our lives.
Right.
And today we're going to dive into something, a little bit interesting. There's a lot going on in the global economy right now.
Mm-hmm.
There's a lot of uncertainty.
Yeah.
And, we're going to look specifically at why India is being highlighted as a potential, a bright spot in all this.
Yeah.
In Asia specifically.
Yeah.
So forget about just the headlines, we see every day. We're going to go a little bit deeper.
Yeah.
And see, what is it about India that has people feeling so optimistic?
Yeah. And, you sent over this report. It's really interesting. It's called MS Research, Why India is Best Placed in Asia.pdf.
Right.
And I think the goal today is to look at this and really answer the question, why is this research so positive on India, given what's going on in the world?
Right, exactly. And they frame the discussion in this report around 5 key questions.
Yeah.
So I figured, why don't we just tackle those one by one?
Okay, sounds good.
And see, what we can take away from this.
Yeah.
So the first question they ask is, what caused the recent slowdown in India's growth?
Yeah.
And why was the recovery, maybe a little bit sluggish?
Mm-hmm.
It's interesting. It's not like there were any huge red flags.
Yeah, and that's what's so fascinating about this is that they really highlight that this slowdown was unexpected.
Right.
It wasn't caused by, some of the typical things we see in emerging markets, things like a current account deficit, high inflation, unsustainable private debt.
Right.
They didn't see any of that.
Yeah.
What they're pointing to is what they call an unwarranted double tightening of fiscal and monetary policy.
Okay.
So basically saying that the slowdown was a result of policy choices and not some inherent vulnerability in the economy.
Okay, interesting. So double tightening, what exactly does that mean?
Yeah, so let's break that down. So on the fiscal side, which refers to government spending, this is a significant part of India's economy.
Right.
And we actually saw a contraction in government spending.
Oh, wow.
It reached a low point of negative 6% year on year.
Okay.
Back in July 2024.
Okay.
And what was particularly surprising was how slowly government spending on infrastructure picked back up.
Right.
So this is what we call capital expenditure or CapEx.
Okay.
And this averaged negative 12% between May and November of 2024 before we saw a strong recovery to 37% year on year in January 2025.
Okay. So the government kind of, tightened its belt.
Exactly.
More than people were expecting, especially on investments and things like that.
Yeah, and that was a key contributor to the slowdown.
Okay. And what about the monetary side? How did the central bank contribute to this tightening?
So the monetary tightening happened in a few ways.
Okay.
First, the Reserve Bank of India, the central bank, they raised interest rates.
Right.
Second, there was a reduction in liquidity in the banking system.
Okay.
This is the amount of readily available money.
Right.
And that can make it more expensive for banks to lend money.
Mm-hmm.
And third, they implemented some regulatory tightening.
Okay.
They increased what are called risk weights for unsecured consumer loans.
Okay.
So think of risk weights as, a measure of how risky a loan is considered.
Yeah.
So a higher risk weight means that banks have to set aside more capital for those loans.
Okay.
And this can make them less appealing to issue and could impact consumer borrowing.
Got it. So you have the government kind of pulling back on spending.
Right.
Especially in the long term, and then you have the central bank making it harder or more expensive to borrow money.
Right.
So it makes sense that even without some of those classic warning signs, the economy would slow down.
Exactly.
So, okay, so that explains the slowdown.
Right.
The second question they ask in a report is, what's expected to drive the recovery going forward?
Mm-hmm.
And the overall tone of the report definitely gets more optimistic.
Absolutely. Yeah. They're quite bullish on the recovery gaining momentum.
Okay.
And what's interesting is they point to some early signs of this, some green shoots, as they call them.
Yeah.
One major one is the accelerating growth in goods and services tax, or GST revenue.
Okay.
Now, for those who don't know, GST is essentially a unified sales tax across India.
Right.
So higher GST collections generally mean more goods and services are being bought and sold.
Right. More economic activity.
Exactly.
Yeah.
And we saw this revenue grow by 10.7%.
Okay.
On average in January and February of 2025.
Okay.
And interestingly, if you adjust for the extra day in February 2024 because of the leap year, Right. That growth jumps to around 12.6%.
Wow.
Which is significantly higher than the 8.3% we saw in the last quarter of 2024.
Okay, so yeah, I mean that's a pretty clear sign that things are picking up.
Exactly.
So what are the main things they see driving this continued recovery?
Right.
The report identifies 4 key drivers.
They do.
So what's the first one?
The first driver is sustained government capital expenditure spending.
Okay.
You know, we talked about how this was slow to pick up initially.
Yeah.
But the report highlights a marked acceleration in central government capex growth starting in December 2024 and continuing into January 2025.
Right.
And looking ahead, the government's budget for the fiscal year 2026 projects a solid 10.1% year-on-year growth in central government capex.
Oh, okay.
And if you include grants to states for their own infrastructure projects, the total expected growth is even higher.
Wow.
17.4%.
Okay. So a huge push on the government spending side.
A big commitment to public investment.
Yeah. Okay, so what's the second driver?
The second key driver they highlight is what they call the triple easing of monetary policy.
A triple easing.
Triple easing. So this is happening in 3 interconnected ways.
Okay.
First, we've seen a decrease in policy rates.
Okay.
You know, the real policy rate on core inflation is down from 3.4% in June 2024 to 2.5% in February 2025.
Okay.
And they expect further rate cuts.
Okay.
The second is an easing of liquidity conditions.
Okay.
You know, the weighted average call rate, which is essentially a short-term borrowing rate for banks, has fallen from its peak in December 2024 and is now below the repo rate, which is the main policy rate. This is partly due to the RBI being more flexible with their foreign exchange regime and injecting liquidity into the system, which basically means making sure there's enough money available for lending. And the third aspect of this easing is the regulatory measures.
Okay.
The RBI has already started rolling back some of the tightening measures they had implemented earlier, like the increased risk weights on bank credit to non-banking financial companies.
Okay.
So essentially they hit the brakes, and now they're easing the pressure in multiple ways to encourage growth.
Yeah, okay, very interesting. Okay, so the policies that caused the slowdown are now kind of being reversed to encourage growth.
Exactly.
What's the third factor?
The third driver they point to is the moderation in food inflation.
Okay.
And this is really crucial because, you know, when food prices rise rapidly, it impacts households significantly.
Yeah, of course.
So we've seen food inflation decline from a high of 10.9% year-on-year in October 2024 to 6% in January 2025.
Okay.
And this has helped bring overall inflation down to a 5-month low of 4.3% year-on-year.
Okay, that's great.
In January 2025. And the expectation is that this trend will continue, which should help improve real incomes.
By people's purchasing power.
Exactly.
Yeah, okay. And what about the fourth and final driver?
So the fourth driver is the impressive growth in India's services exports.
Okay.
This is a really fascinating development. We're seeing a structural shift in the economy.
Okay. Services
exports, you know, things like IT services, business consulting, software development, have almost doubled since December 2020.
Wow.
And they've been growing much faster than goods exports.
Okay.
As of January 2025, services exports reached an annualized $414 billion.
Wow, okay.
Which is almost on par with goods exports at $426 billion.
Okay.
And what's really significant is that India's share of the global services export market has been increasing. And services exports tend to be more resilient than goods exports during global economic slowdowns.
So that kind of insulates them from global manufacturing downturns and things like that.
Precisely. It makes them less susceptible to the ups and downs of the global manufacturing cycle.
Okay, that's a big deal.
It is a very significant fact.
Yeah, okay, so that's fascinating.
Yeah.
So the third question they ask is, will the recovery in consumer spending become more widespread?
Yeah.
You know, we've already touched on some of these factors. But what are the specific things that they see leading to a broader consumption growth?
So they point out that private consumption has already shown a decent recovery.
Okay.
And, the volume growth of FMCG sales or fast-moving consumer goods, everyday consumer products has picked up, particularly in rural areas.
Okay.
Now, they identify 5 key factors that should broaden this recovery even further.
Okay.
So first, the tax cuts for lower and middle-income households that were announced in the government's budget should give a boost to spending, especially in urban areas. Second, the continued improvement in real incomes, thanks to moderating food inflation, will especially benefit lower-income households who spend a larger proportion of their income on food. They have more disposable income.
Exactly.
Third, the job market seems to have turned a corner.
Okay.
Job creation appears to have bottomed out and is now showing signs of picking up.
That's great.
This is based on indicators like the Naukri Job Search Index. Fourth, the robust growth in services exports should eventually lead to more urban job creation and higher consumption in urban areas.
Makes sense.
But there's a bit of a lag there. And finally, there's an expectation that the RBI will further ease regulations on consumer credit. Potentially by returning to the previous lower risk weights. Which would make it easier and cheaper for households to borrow and spend.
So it sounds like, all these factors are kind of coming together.
They are.
You have tax breaks, rising incomes, improving job market, the spillover from the strong services exports, and then easier access to credit. So it really does seem like things are pointing in the right direction.
Yeah, it paints a pretty positive picture for consumer spending.
Okay, so let's move on to the fourth question.
Okay.
What's the outlook for capital expenditure or CapEx? We've talked about the government's role in this. But what about the private sector?
Yeah, so the report highlights government CapEx as really the key anchor for the recovery and investment overall. They note that the combined growth in spending by both the central and state governments has stabilized at 9% year on year in the fourth quarter of 2024. And more importantly, as we've discussed, the growth in capital expenditure by the central government has accelerated significantly. And the budget for the upcoming fiscal year signals continued strong growth in central government CapEx and grants to states for their own capital expenditure projects. So a strong push from the government there.
Okay, what about the private sector?
Now, when we look at the private sector CapEx, the expectation is for a slower and more gradual recovery.
Okay, and why is that?
So the main concern here is the heightened global uncertainty and the potential for a slowdown in goods exports. Even though India is not as reliant on goods exports as some other Asian economies, a weaker global environment could still dampen investment, particularly in the manufacturing sector. Now, the report does point out that India's lower dependence on goods trade offers some protection, and the easing of monetary policy should also help. But overall, the expectation is that private CapEx will recover more gradually and more cautiously compared to the more robust government-led investment.
So it seems like the government's kind of taking the lead here.
Yeah, they're definitely stepping up.
And the private sector's kind of waiting to see what happens.
Taking a wait-and-see approach.
Okay, so the final question they ask is, what about tariffs and the overall trade outlook for India? Can India avoid these tariffs, and is a trade deal with the U.S. likely? This seems especially relevant.
It is.
Given all the trade tensions we see globally.
Yeah, absolutely. This is a very complex area with a lot of moving parts. The report acknowledges that India does face direct risks related to tariffs. They point out that India has relatively high tariff rates on certain imported goods, significant non-tariff barriers, and a surplus in its goods trade with the U.S., which makes it a potential target for retaliatory tariffs from the U.S. And they even mention the possibility of tariffs being imposed on exports of pharmaceutical products from India, which make up a decent chunk of India's overall exports.
So definitely some direct exposure there. What's the expectation around a potential trade deal between the U.S. and India? And how might that change things?
So the report suggests that a trade deal between the two countries is likely, maybe by fall 2025.
Okay.
However, they also caution that it could be challenging to reach an agreement, given the various bilateral trade issues that exist. And in the short term, it seems unlikely that India will be able to avoid the reciprocal tariffs that are scheduled to come into effect on April 2nd.
Okay.
And tariffs could even increase before a deal is finalized.
Okay, so, India wants to lower these tariffs.
Yeah.
Why can't they just, lower the tariffs on goods coming from the U.S. without having to lower them for everybody else?
So that has to do with the World Trade Organization's most favored nation principle.
Okay.
Essentially, this principle says that WTO members can't discriminate between their trading partners.
Right.
So if India were to lower tariffs on imports, specifically from the U.S., without a formal trade agreement in place, they would generally be required to extend those same lower tariffs to all other WTO members.
Got it.
A free trade agreement provides an exception to this rule, allowing for preferential treatment within the context of the agreement.
Got it. Okay, so makes sense.
Yeah.
So, we've talked about the direct risk of tariffs.
Yeah.
The report also mentions these indirect effects.
Right.
How vulnerable is India to those?
Yeah. So they emphasize that the indirect effects of these trade tensions, things like a decline in business confidence because of the uncertainty surrounding trade policy, the negative impacts on capital expenditure, and just the disruptions to global trade flows, that these are likely to be more significant than the direct impact of the tariffs themselves.
Okay.
Now, from this perspective, India is actually seen as less vulnerable than many other economies in the region because its economy is less reliant on goods exports, and domestic demand is relatively strong. However, the report does caution that this challenging global environment will still have some negative impact on India's growth, primarily through weaker demand for its goods exports and potentially lower investment in manufacturing.
Okay.
So it's important to keep an eye on things like the growth of capital goods imports in both Asia and India as an indicator of, future investment trends.
Okay. So it's a bit of a mixed bag.
Yeah.
There are these direct risks from tariffs, but India's economic structure provides some resilience against, the broader fallout from all these trade tensions.
Right.
So to kind of wrap this all up, what's the main conclusion that we can take away from all this?
So the key takeaway here is that despite this recent and unexpected slowdown in growth, the analysis suggests that India is actually in a good position within Asia, given the current global economic uncertainty. And this is largely due to the expectation of a rebound in domestic demand, driven by, continued government investment in infrastructure, the easing of monetary policy, the moderation in inflation, which is boosting household incomes, and the really strong performance of India's services exports. So these domestic factors are really providing a buffer against the headwinds in the global economy.
Yeah, it's interesting how, this is a much more complex picture.
It is.
Than, just reading the headlines.
Yeah.
Really digging into these underlying factors.
Absolutely.
Gives you a much better understanding of why this report is so optimistic about India.
Exactly. And it makes you think about, how India's economic growth might look different from other nations in Asia in the years ahead. Especially as they're focusing more on services and they're less reliant on goods exports. How will that impact their growth trajectory compared to countries that are more exposed to the shifts in global trade?
Very interesting.
Yeah, something to keep an eye on for sure.
Yeah. All right, well, that's all the time we have for today, but as always, thank you so much for joining us on The Deep Dive.
It was a pleasure. Thanks for having me.
And we'll see you next time.
See you next time.
Bye.